Dell Technologies is gaining considerable interest from investors because it is benefiting from the increasing investment in AI servers. Large cloud service providers, including Amazon, Microsoft, and Alphabet, have spent and continue to spend tens of billions of dollars building new AI-optimized data centers. So if you're one of those investors interested in Dell stock, here's what you should know about the company's recent performance and expectations before you buy Dell stock. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so according to the company's CFO, Dell's total revenue increased by 9% in the latest quarter to $25 billion. And that included the headwind from the exit of their VMware resell business. They previously would resell VMware's products and earn a fee for those sales. So now they exited that business, and so those revenues are not included with their current revenue. So despite that challenge, that headwind, they still generated 9% revenue growth. Gross profit margin was down, however, to 21.8%, and that was down by 230 basis points due to an increase in AI-optimized server mix and a more competitive pricing environment. And why is it that the more AI-optimized servers they sell, the more their gross profit margin declines? Well, there's several reasons. One of them is that I mentioned the companies that are doing most of the spending, Alphabet, Microsoft, and Amazon. Those are large companies that have strong negotiating power. And so they can negotiate lower prices when they're dealing with Dell, and that leads to lower profit margins for Dell. The company saying, let me emphasize, the CFO saying, let me emphasize, we expect solid top-line growth in the second half of the year, even as we continue to optimize our cost structure to enhance our competitiveness over the long term. So in the second quarter, they took a $328 million charge for workforce reductions. They laid off a bunch of people, and the severance packages and the work it takes to identify who to let go, it cost the company $328 million. Dell saying that server demand continues to outpace shipments with strong growth across traditional and AI servers. And this was news to me. Traditional servers, Dell is growing. That's not the case when I look around other companies. What I'm noticing more is AI server growth is increasing exponentially. Very rapid growth in AI servers, but that had been coming at the expense of traditional servers. Companies are no longer building traditional servers, which have been reported to have a higher total cost of ownership, and so they've been switching to AI servers instead. But Dell is actually reporting growth in traditional service as well. Dell's management expects their ISG group, which is Infrastructure Solutions Group, the operating profit margin rate to continue to improve in the second half of the year. That's good news given the pressure on gross profit margin, but they've reduced operating expenses enough to still drive expansion in their operating profit margin, even though their gross profit margin is coming down. If you're thinking about a company, what's the difference between gross profit margin and operating profit margin? Well, gross profit margin only takes into account the cost of goods sold. So you have revenue minus cost of goods sold equals gross profit. Gross profit divided by sales equals gross profit margin. So there's only one cost item in gross profit, while operating profit margin includes most other costs the company incurs, including sales, general and administrative expenses, research and development, headquarters, corporate governance. All of that is included in operating expenses. And so you can still drive expansion in operating profit margin, even if your gross profit margin is declining, by becoming very efficient in your operating expense structure. It's not an easy thing to do. Dell managed to do it in the latest quarter and continues to expect to do that throughout the rest of the year. Undoubtedly, the layoffs will help support that expansion in operating profit margin. So in CSG, which is their client services group, revenue was down 4% to $12.4 billion. They expect growth in the second half of the year, particularly in the fourth quarter, and this is due to the coming PC refresh cycle, and the longer-term impacts of AI will create tailwinds for the PC market. So that's great to hear. The PC market has generally been a mature market with little growth, but because of this refresh cycle, Dell expects a strong second half of the year in this segment. Now, its business is now roughly 50-50 split between the CSG and ISG group. CSG with $12.4 billion in revenue in the latest quarter, ISG with $11.6 billion in revenue in the latest quarter. Investors would much rather prefer the company's revenue be more concentrated in the ISG because that market is still growing and expected to grow because of all the investment in AI servers. And those investments in AI servers are expected to continue for at least another several years. So if you're looking at a business to invest in, you would like a business that generates most of its revenue from this segment that's expected to grow for several more years instead of this personal computer market, which is already at maturity, mostly at maturity, and you're only going to get revenue from replacements. And if you take market share from rivals, and then a slowly increasing average price per computer or average revenue per customer, if you can find incremental revenue sources to drive up revenue while selling a product that's mostly mature. They go on to say they expect Dell Technologies fiscal year 2025 revenue to be in the range of $95.5 billion to $98.5 billion, or roughly 10% year-over-year growth. They also expect ISG revenue to grow by 30%, driven primarily by AI, whereas they expect the CSG revenue to be flat or low single digits for the year. And that goes to point to the evidence I highlighted earlier, how the AI server segment is the segment that's growing, 30% growth expected in that segment, whereas the CSG revenue is flat to low single digits. They expect the combined ISG and CSG business to grow at 13% at the midpoint. Now, they continue to expect gross margins to decline by roughly 180 basis points due to inflationary input costs, the competitive environment, and a higher mix of AI-optimized servers. And one of the reasons why this margin is falling is because of what I highlighted earlier, the increasing negotiating power of the people, the companies that are purchasing these AI servers. These are large and powerful companies that can flex their negotiating power, but also the competitive environment. Dell Technologies rivals, including Supermicro Computer, have taken a market penetration strategy, offering lower prices and better terms to gain market share. And so to compete with that, Dell also has to offer some promotions and incentives to try and retain and keep market share. So it's been a battle of market share in this industry. And I've always said that's not good news for investors. When companies are battling for market share, offering better and better terms, it's kind of a race to the bottom, and it's great for customers, but it's bad news for investors. So these are all items that all Dell stock investors should know. This is just the beginning of what you should know. You should know a lot more about the company before you choose to invest. But at the very minimum, these were things that you should know, and now you know them after watching this video. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.